you're very, very welcome to our April edition of our Practice News webinar. I'm delighted to be joining you here. I'm sure some of you here from Ulster will recognise the Members Lounge here in our Linen Hall offices in Belfast, and Conal is co-hosting with me from South Dublin as well. So this really is a packed agenda we have this morning. We're actually going to be about 2 hours live and some recordings and so on as well, some extra bits. And again, we have actually a record number of attendees, just over 550 bookings. So guys, thank you for your support over the last 3 years now plus for Practice News. It's been great. So Conal, if you can click on to the next actual slide, I'm going to tell you a little bit more about what we're planning to cover today. So we have some of our usual and ever popular items. We're going to kick off just after my introductions with Gerald O'Sullivan, joining us live from Cork with the Irish tax updates. And also we're going to have our UK tax recording from our professional tax lead, Leontia Doran, just after 12 o'clock. Give you the timings now soon. Now, for our spotlight pieces, we're going to start with actually regulation in your practice. Delighted to be joined by Aidan Lamb, Head of Professional Standards Director, and also the Head of Professional Standards Projects, Karen Flannery. And we're going to talk about something audit, AML, not just general happenings of regulation. We're also going to have a good chat, and Conal is going to have a chat with two guys from Plan International. Paul O'Brien, the CEO, and David O'Leary, board member. Plan International is a charity that helps with equality and so on for children and also girls' rights and so on. Well, if you can click back to the slide there again, as I say to you, yes, you can see that, and I'll give you the quick overview of the people as well in a minute. So if you can click back to the news slide there, that would be great. The headline slide, brilliant. And so we're going to have that at about 11 o'clock, a quick chat with Paul and with David. Then we're going to get into some news items, and some big news items we have here. The new Solicitors Accounts regulations coming into play from 1 July 23. And also there's still, and we had a very good overview with Mike O'Halloran and the last session in February on UK and Irish GAAP, the periodic review. And so we're going to tell you a little bit more information, and you can still actually get in your own responses to the FRC by the end of April. And we're going to talk about that growing team sustainability reporting. We have two other pieces as well to talk about. I'm delighted to be joined by Dee Moore, our professional accounting lead, and also Carmel Siri, a mentor with the Dublin Local Enterprise Office, as well as the Head of Economic Development, Greg Swift. We're just going to talk about their experiences and how accountancy practices could help their SME clients to more standardise and improve the information that they provide to LEOs and to other funders. And this is equally applicable to Public Ireland and Northern Ireland. We're also delighted to be sponsored today by Acuvest. And Damian Cooper from Acuvest is going to have a very insightful session, a recorded session with Conal on the actual investment market in 2023. As the headline says, it's definitely not for the faint-hearted. So much change in there. So I'm really looking forward to that session at about 12 o'clock. Conal, if you can click ahead again. Our next picture here, I think I've described most of these people here, as I say to you, with Dee, as I say, our professional accounting lead, Leontia, our UK tax lead, and so on. Your familiar faces. Karen is delighted and great to have Karen and Aidan back as well from Professional Standards. And of course, hopefully most of you know Conal and myself from the Practice Consulting team, and Gerald from the actual tax team. If you can click ahead again. Our special guest, Damian, as I say, is a regular attendee from Acuvest and some great insights into the investment market. As I mentioned, we have from Plan International, that very important international charity for children's rights, Paul O'Brien, CEO, and David O'Leary, who is a board member and a business advisor as well. And of course, we have the Dublin LEOs, both. We have Greg working on the administration side, local enterprise side, and coordinating with SMEs, but also Carmel Siri, a fellow accountant and also a business mentor, giving her insights into just improving and standardizing financial information. So Conal, if you can click ahead again. Our attendees this morning, we've told you who we are, and as I said, a record number of attendees. So there's some interesting insights here. Look, guys, we actually have a lot of people, as you get some practice. We actually seen a good proportion, probably maybe 1/5 or so, that actually come from business. So that's very, very interesting, and obviously some relevant news items to you, no matter what field you're actually in. We're always delighted to have our guests from right across the island. Typically, we have about 20% of our people from Northern Ireland to the UK. You can see from that chart there, every county of Ireland covered. We have people even joining us from as far as field, I understand, as Brisbane and Sydney this morning. So if you're tuned in, I'm not sure it's a good evening or whatever to you, and you're very, very welcome. Guys, if you can click ahead again, Conal. This is our timetable. I'll give you a quick overview where we're at. Delighted to have Garrod joining us with the Republic of Ireland tax update very shortly, 10:15. Personal standards update with Karen and Aidan, 10:35 to 11. We're looking at audit and MAML, the good governance for charity recommendations with Conal, with Paul and with David at 11 o'clock. I'm going to give our practice news updates with Conal, so just those regular news items, so switching that back to mid-show at 11:20. Improving financial aid information with Dee and our LEO representatives at 11:30. We're going to have our two recordings then, Investing in Changing Times with Damian at 11:50. And then we're going to have our UK tax update at 12 o'clock, close at about 12:20 or so. So it's a particularly long show, but there is so many news items that are relevant today. Well, hopefully you can join us for most of it, if not all of the show. So click ahead again, Conal. It's our disclaimer, and this is even more important on this one. We try to cover so much here today. We have so many links on these webinars. So a lot of homework for you if you want to go off and learn the in detail laws, regulations, and so on as well. These are only general slides that actually help us in our actual very busy pack session this morning. So always remember that. Conal, if you can click ahead again. So yeah, on that note, that's my introductions done, and I'm going to call live from Cork, Garrod. Hopefully all is good in your side of the island, and I know you've had you and your team, it's busy as ever. I think everything from the TVES to consultations, I know in both jurisdictions, and even the spring finance bills and different things as well. So you've a lot to tell us about in the next 20 minutes or so. I'm going to give the floor to you.
Hi Jeremy, thanks for the good introduction as always. I'm just looking at that picture there, so obviously a little less bearded at this time of the year it seems, and all good down in Cork at the moment, bit overcast, but look, I think we're coming into the summer months pretty soon now, so certainly starting to look up. I'm going to just move on to the next slide there, so I'm not looking at my face for too long. Yeah, so what I picked out, I suppose, some of the highlights from our work over, I suppose, since the last practice news session. And I suppose to start on our response to the recent public consultation on Ireland's personal tax system. So I suppose we're all working, I just seen the stats there, a lot of us working in practice and employed in practice. And I suppose we're all acutely aware of the amount of income tax we're paying. Always, grateful to be in a bracket where paying a lot of income tax, it is an issue, but at the same time, I suppose we welcomed the opportunity to kind of give our views on where the public or where the personal tax system should be going. And I suppose what I'll do here is summarize some of the points. I've included a link in the slides which you can check out to read our response, and I suppose I think it's a good document where we set out some interesting information on income inequality in Ireland, how we redistribute income, so some interesting points around there, and as I say, we get into some nitty-gritty which I'll go through now. So I suppose one point we've tried to bring out is how heavily our personal tax system relies on higher income earners and international workers for the bulk of our income tax revenues. So this does pose a significant risk to the sustainability of our income tax receipts. That's for sure. It's always the case with mobile people that they could potentially up and leave, and that I suppose it's always to keep that in mind within the global economy we do work in. But that said, I suppose our personal tax system is highly progressive. So while it does rely on the top 25% of earners, it is a progressive tax system, and that is overall a positive. However, I suppose the personal tax base itself has been progressively narrowed in recent budgets, and I suppose research suggests that broadening the income tax base will in fact enhance efficiencies in the tax system to bring more people into the tax net, and I suppose reduce the level of exemptions across the board. As well as that, though, I suppose it's not the point I'm making there around the reliance on high income earners. I suppose what we're trying to suggest is that this personal tax review needs to look at the tax system holistically. So what we're saying there is scope in terms of areas like VAT and property taxes to broaden those tax bases and we think that will be more effective from an overall tax policy perspective. That's in line with OECD thought as well. So I suppose what we are trying to really bring out is, look, if income tax rates keep going up, that's not what we want really. In fact, what we are calling for as well is simplification of the income tax system. Obviously, we're all acutely aware right now that when you come to do an income tax computation, you're applying taxes for income tax, USD, and then you've PRSI tagged on as well. So I guess there has to be, we're asking for a review that focuses on streamlining these taxes, making compliance more straightforward. As part of that as well, we've also continued to call for an intermediate income tax rate of 30%. We called for this in our pre-budget submission last year, and you might recall government certainly discussed the possibility of introducing this middle income tax rate around, I think it was June, July time last year. What we ended up with is, of course, increased rates and increased bands. Now, again, we have also discussed as part of the middle income tax rate as one suggestion, but we've also called for the indexation of rates and bands. I think in particular the standard rate is below the average industrial wage, and that's it doesn't make sense that you're at your standard rate band will be below that average wage. So this is where a measure like indexation should provide some level of equity. Of course, these measures cost money. That's I suppose the obvious point. You can look at revenues ready reckoner to get a sense of the cost of some of these measures. But I guess this is about a forward-looking approach to personal tax policy, and I suppose where these measures will be paid for if introduced is in areas like VAT-based broadening, property tax broadening, things like this, capital tax broadening, and again we feel that overall there isn't a whole lot of scope at the moment to further increase income tax rates. That's for certain. So some other points we mentioned, again, we just to reiterate, I suppose, about at least maybe merging USD and PRSI. If all three taxes can't be merged, certainly there is merit in combining those taxes. I suppose the aim and spirit of those of the USC and PRSI are fairly aligned. Of course, PRSI itself it goes off to its own fund, and we're aware of that into the SIF and things like this. But again, there's no reason why I suppose such an earmarking of funds could not be built into the legislation itself. Some other I suppose more practical measures: the rent tax credit should be made a permanent element of the income tax code, and we're calling for a similar credit for mortgage holders to ensure parity of treatment. And again, this could have a positive knock-on effect into the rental market, for people that may be renting a home with a mortgage. If they can get some level of relief, they might be under less pressure to up rates and things like this. So look, we have a separate paper which we discussed previously, I think, where we've published a paper with Focus Ireland, and it's worth checking out that paper where we sent in some pretty strong proposals to, I suppose, alleviate some of the pressures in the housing market. But look, I think we're all acutely aware of the issues in that space at the moment. The rental room threshold should be increased, and the cliff edge should be removed from the relief. So I think it's 14 grand now, and that's a good bit below what your average rents in certain parts of the country are. And as well as removing the cliff edge, there is an option there for certain, perhaps for individuals with a single home, where they're renting a single home, to perhaps avail of some level of relief on the first level, a certain element of their income anyway, their rental income. And I suppose the government, we're just asking the government to avoid increasing the administrative burden of the POE system, as onerous administrative requirements tend to be a deterrent to entrepreneurism. So it's always that fine balance, isn't it, between an effective and robust tax system and a system which also doesn't get in the way of business, and that's always going to be attention in tax policy. So I would encourage people on the call to take if you have 5-10 minutes to read some of the points and get your thoughts. We just also mentioned we call for START to be legislated on a permanent basis. So we have some more specific measures there, and certainly if any of the people on the call have any thoughts on how maybe on the points we've raised, or maybe have some other views on some of the points we raised, would very much welcome your opinions and views there. Just to move on to the Investment Tax Guide 2023, which we launched, which the Goodbody launched in partnership with ourselves. So this document, we spent a good bit of time reviewing this and looking into it, and it's a very strong and a very helpful document, which I suppose we feel it genuinely is adding something into the public interest, and that can be certainly a very virtuous statement if not qualified. So what I find very beneficial about this document, it covers pretty much the full range of investments that your clients are likely to present to you. So, particularly when it comes to income tax filing time, and you're sent in this book of investments. Some of the providers obviously will nicely categorize things, but what this will set through, this will go through the different investments: bonds, shares, REITs, deposit interest, investment undertakings. It also contains a very good section and a robust section on offshore funds, and as I call them, the good, the bad, and the ugly of offshore funds. And we do set out the various things to consider in determining whether a fund should be considered good or bad, and the tax treatment associated therewith. So, you can think of things like ETFs, for example, where there's some interesting commentary on ETFs, and particularly in recent years, US ETFs, where sometimes they can be a good offshore investment, sometimes a bad offshore investment. And it does just bring out some of the things to consider in trying to arrive at a conclusion with some of those products. I mean, if you open, again, the link is there, so you can download a copy for free. But for example, if we think about bonds, it's covering Irish corporate bonds, Irish government bonds, and then it will cover the tax treatment of overseas government and corporate bonds. Again, with shares, it will go through Irish shares and overseas shares. So again, while you might be getting your readout from a client's investment provider, this document it started at the very least be a good sense check. When you're advising clients, if a client asks you maybe just for maybe some high level feedback on particular types of investments, this document will really save you a lot of time, because it's thoroughly checked. Obviously it's got the usual caveats, the disclaimers, etc. But the document you should be able to put a good bit of reliance on. So I would certainly recommend picking out this document if you're working in this space, or even just for your own personal knowledge. If you are in the game, we say, of putting some money into stocks and shares and different investments, this document will certainly be worth a read, and it's certainly worth having on your desk as a reference when you need it. So yeah, as I say, the link is there. You can put in the relevant details, and you should get a copy into your inbox relatively quickly. So just moving to the Department of Finance Business Tax Stakeholder Forum. So I just want to mention briefly, I just want to discuss this at a high level for now. This is the Department of Finance reached out to some of the membership bodies ourselves, well, CCABI, which we're a part of, and which I suppose we kind of lead the charge on. Law Society, the Institute of Tax, the American Chamber of Commerce, IBEC, Revenue, and then the Department of Enterprise, and obviously the Department of Finance were all represented at this meeting. So the plan is to hold this meeting maybe 3 to 4 times a year, and it's, I suppose, an opportunity for the Department of Finance to get the views of the various business tax stakeholders. So as I say, the Department of Finance chaired this meeting, and I must say it was a very, very interesting meeting where they covered EU and international tax developments. In particular, they provided an update on some of the recent developments at the OECD Global Tax Agreement and the related EU minimum tax directives. So this is the Pillar 2 stuff. Now, I appreciate for people on the call, and for most of us, to be honest, working as accountants and tax advisors, the Pillar 2 type minimum tax legislation and the EU directive that's designed on top of the OECD rules, it's sort of a distant beast, right? So I certainly appreciate that, but I think the implementation of Pillar 2 will have a pervasive impact on tax practice in Ireland for the next 12 months anyway, because, you know, this is a brand new tax system and it's going to require significant level of time investment from right across government, from ourselves as your representatives at these various fora. So it really is going to be the I suppose the main game in town for the next couple of months. What's very encouraging about the Pillar 2 is that, you know, the department really wants to engage with ourselves, ITI, Lawstock, and the various bodies to get views on how to implement it. So, you know, hopefully coming out of this, it will continue a kind of the good spirit of, I suppose, coming to us stakeholders for our views, to identify issues before they arise. You know, the last thing you want is for legislation pushed through without, I suppose, checking in with the people it will impact, you know, and it could potentially miss a trick. So I think that's very encouraging, a very encouraging headwind, I suppose, if I could call it that. The Department of Enterprise also provided just an update on recent EU industrial plan developments and changes to certain state aid regulations and a revised EU foreign subsidy regulation. So it was interesting discussion there from the Department of Enterprise. And then the Department of Finance closed with just an update on domestic direct tax developments. So, you know, a bit around the work plan for 2023, which obviously centering around Pillar 2. As part of that, last year we introduced, we responded to a consultation on a proposed system for a proposed territorial system of taxation. So this again would have potentially have a great impact for SMEs, because it would potentially make doing business internationally a lot easier. And I think, you know, Irish SMEs, there's a lot of scope in our economy for SMEs to really, you know, expand and grow internationally. But obviously, the tax system is potentially deterrent there, and the system of double taxation we have at the moment can become very complicated and therefore costly to administer. So the hope is that a territorial system of taxation would make I suppose doing this kind of business a bit easier. So we got a chance to, I suppose, reiterate some of our views there, and we have followed up with the department to try and push that agenda along as part of the Pillar 2. So I suppose for SMEs, the opportunity to upgrade the system of taxation in Ireland to the territorial system could have a good knock-on impact for SMEs. And again, we'll keep you updated on that as things develop. Moving on, Derek, so just a quick update on the Spring Finance Bill, and as part of this, I'll discuss some of the updates on TVET. So this was announced on the Spring Finance Bill was announced by the government on the 21st of February. Section 1 of the bill amends 5 agricultural tax reliefs. So the Section 285D, which amends it updates the publication requirements for the acceleration of wear and tear allowances for farm safety equipment. That had to be updated in line with ABER, the EU agricultural block exemption regulations. So, yep, that relief has been updated. Section 604B is amended, extending the relief for farm restructuring to 31 December. So there's also been updates to other accelerated capital allowances for capital expenditure on slurry storage. Stock relief has been amended and extended for young trade farmers to 31 December 24. The section now also includes the definition of micro or small enterprises. So for those working with this legislation to be familiar, and also the stock relief for registered farm partnerships has been extended to 31 December 24. Section 2 of the bill amends the revised rates for mineral oil tax, and they're applicable since 23rd of February of this year. And it also provides for the phased restoration of the rates in relation to petrol, diesel, and marked gas oil by 31 October 23. Section 3 of the bill amends VAT cap, so it's extending the temporary 9% VAT rate to 31 October for gas and electricity supplies, and the 9% rate is extended also for hospitality and tourism until 31 October. And the amendment also provides for the zero rating of supplies of COVID-19 testing kits. There has been some updates to stamp duty. So the stamp duty relief for young trained farmers has been extended to 31 December 25, and the period for which an individual can qualify this relief after acquiring land is reduced from 4 years to 3 years. And farm consolidation relief has also been extended to December 25. So moving on to TBES, Section 5 of the Finance Bill, of the Spring Finance Bill amends certain sections of the TBES. So just to mention here that we sent out letters to Ministers Coveney and Minister McGrath back, or I think it was in February, and end of January, sorry, and basically we called for certain updates to the TBES, and this is in line with feedback that we'd been receiving from members, particularly at the various CPD conferences, at CPD blitzes and the annual tax conference that we ran before Christmas. So what we called for in our letters was, so we mentioned that many businesses are failing to reach the 50% unit cost energy cost threshold. There was a suggestion that sometimes the registration process was that businesses were finding the registration process slightly difficult to work through, more so in terms of how to collate the various bits of information, etc., etc. And I suppose we also wanted to mention that TBES didn't provide for businesses with unmetered energy sources, so the likes of LPG and things like this, and that was continually coming up. So our suggestions were that government reduce the energy cost thresholds from 50% to 30%, and that they simplify the process involved in making a claim for the TBES, and that a mechanism was introduced for unmetered energy sources to claim under the scheme. So since then, the updates in the finance bill have seen the TBES extended from February to May, with a potential further extension to July. The specified period is extended also to May, and the energy cost threshold reduced to 30%. Now, this applies retrospectively to 1 September 22. So if you've been attempting to submit claims for clients in September, and you said, no, they didn't meet the threshold, they're at 40%, or maybe they're at 38%, whatever the case may be, you're now in a position to be able to revise, if you submitted those claims right through to revenue will update it. But say if you stop the claim, if you just give up on the claim because you could see they're not meeting the threshold, you can go back now and you will be able to make those claims right the way back to September. Relief is increased then on the increase in energy in the threshold from 40% to 50%, so an increase in the claim period. And also, while it's not clear yet how, there should be some scope for the legislation includes scope for businesses that are using unmetered power sources to make a claim. So I suppose pleased to announce that the lobbying that we made on your behalf has led to some meaningful change in the TBES, and hopefully you're finding some benefit for you and your clients in using this system currently. So lastly, just to discuss I suppose for anyone working in income tax in particular, the sort of elephant in the room will be the rules around non-resident landlords and the compliance for non-resident landlords. And I guess we have some positive feedback there from a meeting that occurred yesterday with Revenue, which my colleague Ornia attended, and she's the other tax manager here at the Institute. And they're introducing a system whereby tenants and collection agents can log on and withhold tax kind of in real time as they go. but we also have suggested that this should be available to the landlord, the non-resident landlord. So while it's not ideal, it still means that at least the non-resident landlord should be able to go in and withhold tax as maybe on behalf of the tenant. So if you're receiving your payment of €1,000, you'll self withhold the tax over to revenue, so you just pay over the 20% of that. And we're continuing just to let revenue know that while we accept that the requirement for tenants of non-resident landlords to withhold tax is a legislative requirement, practically there are quite a lot of difficulties in getting tenants to comply, and just we're continuing to liaise with revenue on that, and it seems the feedback from yesterday's meeting that took place is that there are some we can expect some positive development in this space, certainly well in advance anyway of the heavy tax filing season. Look, I'll give back 3 minutes. I think I was meant to go out to 25 past, so I'll leave it there for now. Listen, Jeremy, thanks very much for having me on to give the tax update, and I hope some of that was useful now to people on the call today.
I'm sure it was indeed, Gerard. As ever, thank you for a very, very comprehensive update. I have to say, we had a couple of comments there on T-Best, so we're going to ask you to keep an eye on the actual Q&A there, so you might be able to answer them, and hopefully you can stay with us or be back after 12 o'clock or so. Actually, if you have any further comments or thoughts from anything you hear there as well, it'd be great to get your insights. I will say I've actually, I remember I downloaded and actually got a copy in the post as well of that investment tax guide. So it's very comprehensive, as I say to you, and I know it's been a very busy period, as you outlined there, be it consultations, a lot of good work and a lot of valid points, and as you've shown even with T-Best and different things as well in the consultation process and the putting forward the voice of the Institute and our members towards work. Can be gradual, can be whatever else, but it does work. So thank you for you and your team and your efforts in that regard. So Gerard, I'll leave you in the background to be checking the messages, and thank you again for a very comprehensive update.
Jeremy.
On to our next actual segment, and I'm delighted to be joined by my professional standards colleagues. First of all, the Director of Professional Standards, Aidan Lamb, and also by Karen Flannery, Head of Professional Projects in Professional Standards. I think you're definitely, neither of you are newbies here to actually practice news. You've both been on a number of shows, so it's great to have you back, guys.
Thanks, Jeremy. Good to see you this morning.
Brilliant, brilliant. Listen, this morning we have, I suppose, two main areas that I know you want to talk to us about. And Karen, first up, and these areas we've been, I suppose, outlining their importance to members over the last year plus. On the audit side, Karen, you have a couple of things just to remind the members about areas where you're following up with our members on the audit side. So I'll give the floor to you.
Thanks, Jeremy, and thanks for the opportunity to speak to listeners here this morning, because it's always great to have a chance to emphasize some of the regulatory obligations that people have, and I think that helps towards compliance. And as you said, we're going to focus this morning initially, at least, on just some areas of emphasis in the context of audit. And I suppose it's timely to start by mentioning the requirement which comes into effect this month, that is for sole practitioner auditors to have in place alternate arrangements which would come into effect in the unfortunate event of the death or incapacity of the sole practitioner. And this requirement was introduced in the audit regulations a year ago in April 2022, but there's been a whole year of a lead time to allow compliance with this, because it does take time to put in place alternate arrangements. But at this stage, all sole practitioner auditors should be compliant. And I just wanted to draw attention in particular to some FAQs that Professional Standards has put together and is available on the Institute website. And the link is in the slides there. So when people get the slides later on, if they want to follow through there, they can. And I suppose the key message in those FAQs, and there's a bit of detail in there, but the key message is that alternate arrangements will vary from firm to firm, and they depend on the circumstances and needs of the sole practitioner in question, and indeed the firm or individual that is stepping in as the alternate. And a really important point there is that, you know, that it's very useful to take legal advice when putting these arrangements in place to make sure that everything holds up in the events that they're actually called upon. So just a point of emphasis there. The second thing I wanted to focus on is the CPD obligations for responsible individuals. And this is something that we've been talking about quite a bit, when we've had opportunities to address fora like this over the last year. And the enhanced requirements in relation to audit CPD for RIs are required by IASA CPD guidelines, and that's reflected in the audit regulations. And these have been in place now for a full year at this stage. So we're at the point where very recently the Institute has sent requests to all RIs asking them to make a declaration in relation to their compliance with that those CPD obligations in relation to audit. And that submission is due to be returned to the Institute by the 28th of April, which is just next Friday. So I'd strongly encourage anyone who's listening who is a responsible individual and hasn't returned that declaration of compliance yet to kind of give it a bit of attention in the next few days. Make sure you get it into us. And anyone who has any difficulties or problems with that, please do get in touch. Rather than just letting it lapse and create a difficulty down the line. Another point on this is that since the start of 2023, the CPD records of all RIs are being reviewed in conjunction with audit monitoring visits. So all RIs will have their CPD records reviewed at least once every 6 years. But just to note that they can also be selected outside of an audit monitoring visit on a risk basis. So some people will be getting those requests as well. And it's probably useful to give some comfort and say that based on the now admittedly small sample that we've seen on audit monitoring visits so far, there's reasonably positive evidence of compliance, and we have seen quite a bit of use of the Institute's template for recording RI CPD in the process of planning CPD, undertaking it, and that reflective evaluation piece as well being documented using the template. So it just to flag as well that that's available on our website, and we have a resource hub there in relation to RI CPD, which is useful for anyone looking for information on their obligations there. Colleagues have also asked me to mention the UK approach here, that RIs with UK audit registration, really are encouraged to take the same approach in relation to recording their audit CPD, because it's a useful way of capturing everything. And the detail regarding audit CPD is not as explicitly set out in UK audit regulations, but has long been a requirement for all responsible individuals to ensure their competence through undertaking appropriate CPD. So the templates and so on that are there for the Republic of Ireland CPD recording are useful in the UK context as well. So just to flag that as well, and the Institute approach for the UK is very much aligned to that we're taking in Republic of Ireland. Colin, I might ask you to move on to the next slide there for me, please. Just wanted to mention a few matters which we have highlighted in the recent regulatory bulletin, which Professional Standards published for members towards the end of March. I'm mentioning these items in particular because they're all items that have been raised with the Institute by IASA following a recent oversight visit. So they're matters that are very much the forefront of our minds at the moment. The first point to note is the requirement to notify any changes or any particular changes to the Institute on a timely basis. And this is a requirement of Audit Regulation 2.11. Promptly in this context means within 10 business days after the event occurring, and the kind of changes that we're talking about are any matters that would be relevant to the fit and proper status of the firm, its principals or employees, any matters relevant to the firm's or RI's eligibility for audit registration or ability to conduct audit work, and a range of other details that need to be included accurately on the public audit register. And just mentioning this in particular because it's important not to wait until the next annual return submission date, because failure to notify the Institute within the 10 business days of the event is a breach of the audit regs and therefore can have regulatory consequences for a firm, including possible regulatory penalties, which everybody wants to avoid where at all possible. In the context of the public audit register, a couple of other points to mention, and when we're talking about the firm annual return, there is a certain amount of standing information in there, and just remind you, auditors, to give careful attention to the review of that standing information when submitting the firm annual return to ensure that it remains complete and up to date. And I wanted to mention one particular piece of information which is required to be included on the public audit register, and that is the details of the management board of a firm. Now, different audit firms set themselves up differently in terms of their approach to the form of management and administration of the firm. Some firms choose to create a separately identifiable management board, but others choose not to create an additional managerial level, which is distinct from principals, the principal group itself. And to date, the approach adopted by the Institute with regard to information contained in the public audit register regarding management board has been only to denote individuals as management board members, where we've been informed by a firm that there is a separate management board in place. However, following the recent review from IASA, we're now required to obtain the names of management board members for all audit firms for inclusion in the public audit register. So where a firm doesn't have a separate management board, it should provide to us the names of the principals or shareholders to be denoted as management board members on the public audit register as the people who are responsible for the management and administration of the firm. So you'll be seeing a request for that information coming from the Institute in due course through annual returns and so on. And then just the last point that I wanted to emphasize is just a reminder in relation to networks, and auditors are required to notify the Institute of where the firm is a member of a network and where the details of that network are maintained, for example, on the firm's website. And we would just remind firms of that obligation, and also encourage you to look closely at the definition of network that's included in the audit regulations there at 212. And it's particularly relevant in group situations because firms mightn't always be mindful of networks arising in some group situations. So just an encouragement to revisit that definition, and where relevant to let the Institute know that the firm is a member of a network. And as I've mentioned, all of these matters are highlighted in the recent regulatory bulletin that we've issued. And just when I'm here, I'd like to remind all listeners that the regulatory bulletin, which we issue 3 or 4 times a year, it is an important channel of communication between the professional standards department and practitioners, and not just in the area of audit, but across all the regulatory topics. So I'd encourage you to give careful attention to the topics covered there. And, you know, as you read it, if there are any questions that arise or any matters that you want to get in touch in relation to, contact details are provided in the bulletin. And we're always happy to engage with firms and to answer questions to just try and make regulatory obligations as easy to comply with as possible. So just an opportunity to emphasize that there. So I guess that's really all from me here this morning. So I'll go back to you, Jeremy, and I think you're going to have a chat with Aidan on another regulatory topic.
Indeed. Karen, thanks very much. Some very timely updates there in what is a very rapidly evolving area now of audit regulation. You mentioned there, yes, the regulatory bulletins. Actually, on the next slide, if Cornwall happens to just click ahead there, we have a link to actually the most recent regulatory bulletin issued at the March, actually issue 34, and also
that's great.
A document as well for the Professional Standards Board and actually your department team's annual report as well. If anybody, I suppose, ever wants to get an overview really of the, I suppose, the very wide gambit role that Professional Standards and Professional Standards Board covers, and there has been changes this over recent years as well. It's very easy to read report and just the activity and different regulated sectors as well. So please do download that. Karen, thanks again, as I say, for that, and I know you'll be staying with us as well, and we may have other questions in there as well, as I say. Aidan, it's great to have you back again on Practice News with us, and thanks again for joining us. This morning, I'd like to have a chat with you for the next 10-15 minutes, I suppose, with relation to anti-money laundering in both jurisdictions, the UK and in Ireland. And just, I suppose, firstly, I have 2 or 3 areas to talk about, but firstly, to talk about your changing regime and professional standards of audit and about actually anti-money laundering in particular but sometimes they used to be combined in the past. Now we're seeing more maybe standalone visits as well in both jurisdictions. Can you tell us a little bit more of the background to that and maybe future plans that you have in this area as well?
Yeah, thanks, Jeremy, and good morning, everybody. I suppose just before I answer that question, when Karen will have alluded to it in some of her comments during her piece. A lot of these new regulatory requirements are really emanating from oversight inspections that we have had ourselves from IASA, from FRC, and indeed in the AML space that we can talk about now from AML supervisors, particularly in a UK context. We don't sit around every day dreaming up how we can make life even more difficult for practitioners. We do appreciate that things are very difficult in terms of the compliance space, keeping up to date across the whole range of regulated activity. And we do, where possible, push back when we are faced with having to introduce new requirements. But sometimes we just have to move forward and implement change where our senior partner, if you like, whether it's FRC, whether it's IASA, require us to do that. And the whole anti-money laundering space is an area that has been receiving much closer attention in both jurisdictions in recent years. I suppose pre-Brexit, that was being driven largely by the EU. So, changes to anti-money laundering requirements through criminal justice legislation in Ireland has emanated from a range of European Union directives. Obviously, with Brexit, the UK is no longer subject to European legislation, but nevertheless has continued to pay close attention to what's going on there. And indeed, there's really a global response to this and being driven by FATF, Financial Action Task Force, which is a global organization responsible for, I suppose, combating the production of guidance and requirements on combating of money laundering and financial crime. So you're seeing very much regulatory regimes in many jurisdictions kind of mirroring each other and being quite close in terms of their requirements. So what we have seen more recently, as is mentioned, OPAS, the Office for Professional Body Anti-Money Laundering Supervision, bit of a mouthful, which is a UK organisation sitting within the Financial Conduct Authority. And it has been in existence for 5 or 6 years now. And we get regular inspections from it. We engage regularly with it, maybe 3 or 4 times a year on policy developments, new requirements that they're thinking about introducing. And we do similarly with the Anti-Money Laundering Steering Committee of the Department of Finance in Ireland. And in fact, we are members of that committee at this stage. And what we're seeing really is a widening of scope of activities and entities that are impacted by anti-money laundering legislation, whether it's accountants, whether it's lawyers, whether it's dealers in high value goods, et cetera. Wide range of activity now caught with obligations to detect and prevent money laundering. And people on this call, on this webinar today, will be familiar, hopefully, with the toolkit that Practice Consulting produces, which is packed full of helpful advice and guidance, checklists, etc., on processes and procedures that firms need to have in place to comply with their AML obligations, and also in there, in terms of impacts on the bodies. So we are a supervisor, as are the other accountancy bodies, are those practice inspection requirements, supervisory obligations, and I've previously referred to AML as the new audit. Everybody's familiar down through many years of having audit inspection visits, and we're now seeing this visit requirement now apply to the anti-money laundering space. So we've been under pressure, both from UPBAS and in the Republic of Ireland, to develop, I suppose, visit cycles. We haven't had visit cycles to date in the AML space. Our visit selection has largely been risk-driven. So people will be aware in their firm annual return. They now contain a number of questions aimed at gathering information to help our AML supervisory activity. But as regulatory requirements become more sophisticated, become more intense, we are moving to, as you mentioned, AML only visits for higher risk, or for firms that are assessed as higher risk. And those cycles that we will introduce depend on that kind of risk profile. So the firm may receive, a higher risk firm may receive a visit every 2 years. On the other hand, a low risk firm might receive a visit, might be a 7 or 8 year cycle. It really all depends on that risk assessment process. And those visits will be a combination of, they may be exclusively on-site, they may be hybrid, so we might do a portion of them on-site and a portion of the visit off-site, or indeed may be entirely desk-based, where we're asking a firm to send in details of its AML processes and procedures, and we will have a quick look at what firms have in place, and obviously advise the firm where we feel there are issues that need to be addressed. I would say that most of our firm population is falling into that kind of medium to low or low risk categorization. So we don't anticipate doing a huge number of firms on a regular, back to the same firm on a regular basis. If I'm looking at the statistics that we have recently compiled, I think we have less than 30 firms on the island that we would categorize as medium to high risk. So that would hopefully give firms some reassurance about how frequently they might receive a visit. And yes, while I have referred to AML only visits, I think where possible, and where it's not imposing any too much additional burden on firms' time, we may try to tag on an AML element to an audit visit, for example, where a firm is going through an audit inspection visit. But bear in mind as well, we're seeing a reduction in audit firm registrations these days as well. I think our year-end number for year ending 2022, which is, you mentioned our annual report, a lot of the information is flagged in there. We've probably in around 650 audit registered firms now between both jurisdictions, but that number is still continuing to decline. So we will see in the future, likely more AML only type visits taking place.
Well,
sorry, I've gone on for a while there.
No, it's great to get that background, as I say to you, and I suppose it just sets in everybody's mind to be prepared that some people here today wouldn't have audit registration, and so consequently mightn't have been through a monitoring visit in a long time, if ever. And just to be aware that this is possible as well. And so it's great to the background where it's coming from in both jurisdictions. One very interesting common finding, and I know you've discussed this in more detail, and we'll indeed cover it in our own dedicated AML webinars over the coming weeks and months as well, is with relation to a lot of firms now are trying to take, let's say, the drudgery, for the want of a better word, of the extra compliance needs and work on AML that it brings to you by using e-verification systems, and some very good packages and systems available in both jurisdictions. But one very interesting finding that was coming up in lots of practices, and you were saying to me, is that some people take this as being a silver bullet that'll fix all your ills, but it isn't quite that simple, Aidan, yeah?
Yeah, I mean, I think speaking to colleagues who are involved in the inspections, we're seeing more and more examples of where firms have decided to to acquire the kind of software packages that address a lot of the I wouldn't call it the drudgery, but address a lot of the more routine aspects of compliance with the AML obligations, so the due diligence requirements, customer identity, etc. And there are a range of packages out there. We as an institute participate in various fora with other AML supervisors, particularly from the accounting sector. So the various accountancy bodies in Ireland and the UK, we would get together on a regular basis just to discuss common issues. And this one comes up time and time again, not the principle of using software packages in particular, because a lot of them are very good and they do what it says on the tin. But just firms need to be aware that there are the quality differs amongst the kind of packages, and not all are equal. So the firms need to understand what a package is giving them. Some simply do the verification piece. In other words, yes, this person is who he or she says they are. This is their address. So some also do, but that's all they do. They wouldn't necessarily perform risk assessment underlying an entity or individuals. They wouldn't necessarily do the ongoing monitoring requirements that might be there, or may not do any international checks, so they may not do beyond Ireland or the UK. So these packages are a means to an end. They absolutely can be very helpful and useful to firms, but just be aware that they will be of varying quality. And some may deliver less than others. Ultimately, the obligation and responsibility in terms of compliance rests with the firm. They can't turn around and say, well, I relied exclusively on a software package.
Brilliant. And in our last couple of minutes, as I say, because we are looking to, I think, stop at about 11 o'clock or so, I know, particularly from the UK point of view, there's been quite an amount of change. First of all, we have our new SARS portal coming in with the NCA. I don't think maybe any accountants firms, maybe some very large ones, have so far been working on the new portal on a trial basis. But that's something I know that the Professional Standards team has been working in collaboration with the NCA and other accountancy bodies, and indeed other regulated bodies in the UK. I'm sure you'd urge everyone to register themselves, because I do think if you're on the existing portal, you'd have to re-register on the new portal. And indeed, as well, in the Republic of Ireland, we're always putting out the call, and Garda Síochána as well are asking for firms to register on the actual Go AML system. My last figures we had here is it was amazing that maybe less than 1 in 8 of the actual accountancy firms, no matter what body they may be a member of, would actually be registered. Aidan, that's something I'm sure that's ongoing on both sides for your team.
Yes, absolutely. You're right. The SARS portal in the UK is currently being upgraded. It has been rolled out already, I think, to the kind of larger financial institutions and possibly even larger, the very large accounting firms in a UK context. In due course, it will be cascaded down to smaller entities in the supervised sector. So just firms just keep an eye on regulatory bulletins and indeed other communications from ourselves, which will carry updates on where that new system goes live. You're absolutely right, Jeremy. I mean, in the Republic of Ireland context, we engage regularly with Garda Síochána and revenue in terms of AML developments and what's going on out there. The Go AML system is something that is continually highlighted to us as being an extremely helpful system and mechanism. for both sides, for crime enforcement agencies such as the Guards and the Revenue, but indeed from our own practitioners and firms. And it is even a source of useful information. I mean, one gets alerts through that all of the time, mobile phone scams, etc. Lots of alerts of that nature get posted onto the Go AML system, and it is something actually that firms will be asked if they are registered for Go AML when they actually get a visit. I mean, it does demonstrate a commitment to and awareness of their obligations in this particular space. So I would encourage all firms to go to the Go AML portal and get signed up.
Thank you, Aidan. On that note, and it's always good to leave, I suppose, a little bit of homework for accountants in both jurisdictions to get signed up, and to, if you're in the UK, to keep an eye out for the NCA portal as well, as I say to you. I know there's many other things that we could talk about with relation to the UK system. Time, unfortunately, isn't on our side, Aidan, but I'd like to thank both you and Karen again for coming on to Practice News this morning. Some great insights there, and very timely insights as well. I know, Karen, I think you might be staying with us for a little while, and Aidan, I know you have to skip off, so thank you for being with us today. Listen, on that note, I'm going to hand back to Conal, and I think we have our guests from Plan International here as well.
Thanks very much, Aidan and Jeremy. That was very interesting as always, and I'm delighted to welcome our two guests, Paul O'Brien, the Chief Executive of Plan International, and also David O'Leary of DOL Associates. David is an independent non-executive board member and a board member of Plan International. So Paul, you're very welcome.
Thanks very much, Conal.
And I suppose just to begin with, for those who are not familiar with Plan International, perhaps you just give us a brief introduction to that charity.
Okay. Listen, I'm delighted to be here. It's a great opportunity for us. Maybe if I can, just to tell you a little bit about myself. My name is Paul O'Brien. I'm about 35 years in the sector, working in development and humanitarian responses. I started many years ago in Concern, working out, as we say, in the field, in places like Sudan, which you see in the news at the moment, and worked for about 15 years overseas in different developing countries. I found the longer I stayed in Concern, the further upstairs they shoved me. So they sent me up into senior management for a number of years, and I was there in the head office in Dublin for about 11, 12 years in the senior management team. I suppose that's where I learned a lot about governance, which I'll talk a little bit about in a moment. I joined Plan 6 years ago. I expect that most people here in Ireland probably haven't heard of Plan International. It was founded in 1937 during the Spanish Civil War, when the German Luftwaffe were bombing a lot of cities. And there was a lot of unaccompanied children or orphans around the streets. And this British journalist responded by trying to look after those kids. So it has a very strong focus on children. And as it evolved over the last 85 years, it has continued to focus more so even on girls. It continues to focus on children more broadly, but especially girls. I think because what we've seen is in different developing countries, girls and women are like second-class citizens. They get less nutrition, they get less education, they get less opportunities, and they're often told when to get married, who to get married to, and how many children they will have. But in general, I suppose Plan International is a bit like Concern, Goal or Troca and the work that we do, with a strong focus, as I say, on education and early childhood marriage. Plan International Ireland was founded about 20 years ago. And again, we found it hard probably to break in and become a bigger brand we would have liked to have had. But we are registered with the company's registrations office, which we do. So we're with the CRO. We're also with the CRA, the Charity Regulatory Authority, and registered there as well. I suppose we see governance, and I think this is, maybe David will comment on this. Like, I'm the CEO, but essentially I'm running the organization on a day-to-day basis. But really the trustees or the directors are the people who are ultimately responsible for the organization in terms of exercising control. And they are also legal responsible for the charity in that as well. And they have to act collectively, as we know, at the board level. But they are personally responsible, more so than I am as the CEO. So they trust me to do the job. I suppose we have a lot of legislation that we're trying to follow. And that legislation includes the Companies Act from 2014. It includes the Charities Act going back to 2009. But especially, and this is something actually over the years that we really welcome the Charity Regulatory Authority. And that may seem strange, but we do. Because up to about 2014, if you wanted to start a charity here in Ireland, you could get out your bucket and you could go and collect money and you didn't have to register. Now you do, and it's setting standards, and it's standards we are not just happy to follow, but delighted even to be kind of ahead of if we can. So when I think about governance, I suppose, and maybe David can confirm this, I kind of see our board a little bit like as if they're in a helicopter hovering over us. I keep an eye on what we're doing, not too far high, as in not to be able to see, but not too low as well as getting involved in the day-to-day. But yet in the helicopter, they can deep dive in on certain issues, which we welcome them to do so, let's say on strategy and things like that. So they make sure that we follow the legal requirements that we have to do, and we report to them on various sort of standards that we're obliged to adhere to. We kind of see it across four key elements. With the board, it's around setting direction, which is the strategy. It's around ensuring effectiveness so that we get good use for money, that we have clarity of roles, both in terms of job descriptions for everybody in the organization, but also clarity of roles in terms of the chair, in terms of the vice chair, in terms of the chair of the various committees that we have and that on the board. We also see things around supervision as the third kind of key element, where it's around control, it's looking at risk, and we report risk at every board meeting, so we go through a risk register. It's also then as well looking at performance and making sure that we're actually hitting the KPIs that we said we would hit. And the last area, I think, which is important for us around governance is around accountability. So reporting to those whom we're supposed to report to. That can include reporting to the board. It can include reporting to our donors, including the public, but also even to Irish Aid and to the European Union who give us money and that as well as the CRA. And I suppose the key sort of document even that we're doing at the moment, and David will be looking at this next week, is there's the governance code, and we have to report against that now. And I think every charity is obliged to do that. And again, we see that as a really good way of making sure that the standards of governance in charities is actually improving and is really being set there. The final point I would make is around what we do as a management team to try and learn. If I mention here in Ireland words like BOHR, Child Fund, Birdwatch, even the ICA recently, Goethe Self-Help Africa, those organizations have all been in the news for the wrong reasons. I'm not going to comment individually on what happened in each organization, but what we do is to try and look at what actually are the issues that were identified at a governance level and go through those one by one as a management team and ask ourselves, could that happen in Plan International Ireland? So if it's something around the credit card, if it's something around the CEO taking cash, we ask ourselves, can that happen here? And for the most part, thankfully, we can say no. But every now and then we see maybe a weakness in our systems that has been identified. And we say, okay, we need to put something else in place here. And we do that through and with our finance committee, and it goes up to the board. And so we have, I can tell you this, we have a list, an action list that actually is picking up learning from each organization who has been in the news over the last 4 to 5 years, has had weaknesses identified around governance and the way things have been run. And we have a plan in place maybe to address our own weaknesses that maybe we have seen as a result of that. And we think that's a kind of a good way to operate and to work, is to try and learn perhaps from the mistakes of others and ask ourselves honestly, could that happen here? Because fundamentally, reputation is kind of key for us. If you lose your reputation, you are really going to struggle to raise money to do the work that we want to do in the developing world. So we look at things like the Good Governance Awards. We love those because we get feedback on our annual report, and we try and incorporate that feedback into next year's report. We're also aware of the Leinster Chartered, the Accountants Awards, and trying to get involved in that. We look at organisations like the Charities Institute of Ireland and the triple lock system that they have in place, just looking at charities and how they fundraise, how they run things. And maybe I'll just stop there if that's okay, Conal, and I'll let David come in maybe to tell you what his experience of being a board member of Plan has been.
Absolutely. Thanks very much, Paul. I mean, all of this has got such relevance to our members, who are many of whom are auditors to charities, and also who act as trustees in charities, which many accountants are asked to do because of their financial knowledge. David, over to yourself. I mean,
yes,
what makes a good board?
Yeah, well, I mean, for me, I think the kinds of things I'd like to focus on this morning. First of all, good morning, everyone. You may or may not know, I've sat on members board of chartered accountants for more than 7 years in a voluntary capacity, and what I help chartered accountants with there is, I suppose, member engagement with a particular, I suppose, frame of reference around innovation and marketing strategy. So it's great to get this opportunity to talk to you all today directly. And I guess you know, from my own personal journey, I completed the Institute of Directors Chartered Director program there in the last few years. And I guess I was looking at, you know, developing a non-executive director part of my own portfolio. And I guess you start to ask yourself the question, well, what do I do next? And I guess I got involved with Plan probably about 3 years ago now, Paul, isn't it, with some help around marketing strategy. And then I was invited to join the board in September 21. So about 1.5 years on the board now. And I guess it's fair to say, Paul will know this, I'm now fully vested in the mission of Plan. I spent a week in November in Niger, looking at the dreadful challenges that the people face there in sub-Saharan Africa, you know, around climate and conflict and so on. And, you know, it brings it home to you about the great good fortune we have to spend our lives working in this and living in this fantastic country. But listen, how did I establish my interest in Plan, and what are the kinds of things that as a non-executive director I was thinking about? And I mean, don't we always say know your audience? So I guess the first thing you'll always maybe look at is your accounts, you know, and I guess if any of you take some time to go and look at the accounts of Plan International, you'll see what a fantastic job has been done there over the years. It gives a very clear insight into the organization and what it does. For me, the next thing was, you know, looking at the management team. And I guess, you know, it's the competence and experience, and you can hear from Paul's personal story. You know, he's a professional with a terrific career and, you know, amazing depth of experience. And I guess if you're looking at an organization, you might ask yourself, well, are we looking at a professional management team, or are we looking at well-meaning amateurs? And I don't mean to say that in a sort of a derisory way. I'm just saying, what do we see there, and how do we understand that, and what do we see the issues that might come from that? I think when I looked as well at the organization, I was looking at the board, and we're looking at diversity. And in our organization, you know, we're serving, as you heard Paul say, we're serving girls, primarily girls, children. And so for us, a recent innovation was we've invited a young woman onto the board. So, you know, it's that diversity. Do I see a diversity in my board that reflects the community and society that we are working with? And do I see an independence of thinking there? You know, from that board, do they have the chops to do that? The other thing that I'm very interested in is the I suppose the cadence of the committee work. And it's looking at what are we going to do and when are we going to do it. I sit on the fundraising, marketing and communications committee. I know how many meetings I have a year. I know what my plan of work looks like. And it's very clear to me from the other committees that they have similar focus, and that I think gives you confidence that that the whole thing is being looked at and worked on properly. And I think finally, just to pick up on what Paul spoke about towards the end of his presentation, for me, I was really, I suppose, nervous when I came to working on a charity board about this issue of risk management. It's one of the most critical fiduciary duties a non-executive director has. And when you look at the risk register of I imagine most charities, one of the most significant risks we manage is reputational risk, because it has the capability to be an existential challenge for the charity if you don't manage that risk appropriately. And I get a great deal of confidence regularly at board meetings. We'll hear an analysis from the management team about a recent issue that may have arisen, some of which Paul alluded to, and we look at we're talked through the issues. We're talked through what the issues were, and we're talked through what we have done, our management team has done to mitigate, manage those risks and amend policies where necessary. So I get a great deal of confidence from that. So I would say, for those of you listening in this morning, that if you're looking at either managing the accounts for a charity, whether you're acting in your own respect as a trustee or non-executive director, or indeed you're managing bequests from someone to charities, I would say accounts, management team, board, committee work, and what do they do around reputational risk? How do they manage because that feeds back to critical management safeguards and issues. So that's it from me this morning, Conal. Great to see you as always. And back to you.
Thanks very much, Dave. And I once again, this is absolute gold dust for accountants and auditors who are considering what are the issues of the charity, what responsibility do I have vis-a-vis the charity that I'm a trustee of or that I'm an auditor of. And finally, Paul, I think that you've got a message for accountants who might be advising people regarding donations or bequests to charities, which is tied up with this idea of the good governance of a charity.
Yes, I suppose it's to just request your members that if they're dealing with people who are dealing with their wills, or if they're dealing with their wealth, or if they're wanting to make donations, it's to kind of think about an organization like Plan and maybe other organizations. But it's a very specific request, because I think for charities like us, what we call the gold dust is this money which is unrestricted. Now, anybody who's been dealing with a charity and knows SORP, the financial regulations that we follow, will know that we separate out restricted money. So if you give me €100 and say that's for an education program in Kenya, I will guarantee that that €100 goes to an education program in Kenya, and that's restricted. But if you give me €100 and say, Paul, that's unrestricted and you can use it as you wish, I can actually make that into €700 by using it against an institutional grant. And that unrestricted money just allows us really to follow our own, dare I say, our own strategy. It's not sending us off maybe to build a school, which maybe we don't want to build in that particular area, but it allows us to kind of follow our own strategy in terms of direction that the board has set with us, and allows us to leverage. Leverage is the word that I would use. So it's to encourage members, if you have the opportunity, encourage people maybe to give an unrestricted donation to a charity, because that is just simply gold dust. If I may, and this is a very specific request, but at the moment, and David knows this, we have 2 vacancies on our board. One is around a HR person with HR skills, and the other is around a finance person. Thankfully, I think we might have filled the HR role yesterday, but we still have a vacancy for somebody with finance skills. So the way to apply, if you don't want to come to me directly, is maybe through Board Match. We have it out there. We try and generally we try and recruit our directors completely independently. So we put up an application on Board Match and people apply, and myself and the chair and a number of others can interview those people and see their interests. So there is a vacancy for a person with finance skills. And I know David is saying, know your audience. we'd be delighted to see some applications there as well. Thank you, Conal, for the opportunity.
Not at all. You're in the right forum to so hopefully somebody picks up on that offer. It's a great charity. I'd recommend it to anyone. So listen, guys, thanks very much for that. Delighted to have you on, and I hope to be speaking to you both again, especially you, David, in our work on the Members Board of Chartered Accountants. And I wish Paul every success with the plan. So thanks very much.
Thanks, Conal.
Thanks, guys.
Good morning, everyone. Bye.
Conal, thanks to Paul, David, and you. That was some great insights there, and indeed I'd like to reiterate the good wishes for Plan International and the great work they're doing here in Ireland and abroad as well. Listen, we're on to our news items. We've moved to mid-show here for a little bit of a change. So Conal, if you click ahead there. For the next 10 minutes or so, I'm just going to talk to you about 3 news items, and Conal, you've won the lead story as well of our most recent Practice Matters edition, which was just issued yesterday on sustainability. So guys, we issue Practice Matters by email for the last year, 8 months or so. Hopefully you've been receiving it. If not, you need to go into my account section on our Institute website and change your preferences that you are getting practice related emails. You can actually download it at that link there anyway, and the previous editions as well. It's a very packed edition here, and we've covered and touched upon some of the stories already. I want to go into detail on 2 or 3 of them now that you may have heard about, and just give you a little bit more detail on where you want to learn more as well. So, Conal,
could I reiterate that by saying, please, if you do nothing else, go into my account and do update your details so that you do receive all these emails. If you're not receiving Practice Matters as a person either employed in practice or in practice, well, then you should be receiving it. So please take a look at that. It would, I think you'd certainly do yourself a huge favour. Now, on to the next item.
My first news story here is the new solicitors' accounts regulations. They've been a long gestation period, but actually just released just before Easter. So you might have missed them with Easter holidays and so on as well. So these relate obviously to the Republic of Ireland and of course are another set for Northern Ireland as well. But the Republic of Ireland version have been the Law Society and its related stakeholders have been working on updating the previous 2014 and which actually still apply at present regulations. And they put out a new set of regulations. They've been working on this for the last couple of years. COVID has slowed it down, and the Institute would have inputs into this as well in our professional accounting team. And we have these new regulations that will come into force for years beginning after 1 July 23. So we just want to give you a heads up on what will be coming into practice there, what's changing, and some of the actual key impacts. So if we go to the next slide, Conal, I'll give you a couple of the things that will be different from the actual still existing regime. So firstly, balancing statements are now going to be prepared on quarterly intervals as they are in Northern Ireland. And as the reporting accountant, you'll be examining these again. So some more work here on this. Again, you'll be expected to file your reports within 5 months now of the accounting date for years that begin on or after 1 July 23. Going to be, and again, this is all, I suppose, about iterations of the regulations where the actual Law Society itself are seeing issues when they look back and where solicitors have run into financial difficulties and irregularities. So there's some more actual emphasis here on test checks with withdrawals of fees notified that are ensured that they're notified to clients. That is something, of course, that can lead to upset for clients, potential complaints and so on as well. So an area that the actual checks here need to actually focus on. And also, if there is anything untoward, looking and doing, say, cut-off testing, posting before and after the accounting date is very, very important. Again, here, you set out clarity with relation to the actual accountant's reporting responsibilities to the Law Society. If they have an issue and come across a suspicion of a deficit, this is something that needs to be actually submitted and details of it as soon as possible, not to hold back, not to wait, no delays there. So that is very, very important. And again, as I say, to provide reasons if the approval of a reporting account in terms of the change or resignation, provide reasons and to give details to the actual law society on that area as well. There are some other changes, and Conal, if you click ahead again, if you want to learn more about all these things, I've just given you 3 or 4 there. We are going to have further guidance. So firstly here, the Institute put out an article about 10 days or so ago. You can get it at the link there, just setting out some more detail on the changes. But looking ahead, we're actually going to have a Regulated Entities Republic of Ireland webinar on 24th of May. I'm delighted we're going to be joined by Rory O'Neill. Actually, he joined us last year as well on this actual webinar. And Rory's from the Law Society, works on their examination funds and also works on their compensation fund side. He's going to give us the Law Society's insights into these new regulations and their work over the last year as well. So if you have clients in, be it auctioneers, be it even charities, different things like that, any regulated clients, insurance brokers, there's another one, please do come along to that webinar. And whether you're in the Republic of Ireland or if you have clients in the Republic of Ireland in those areas. So please do check it out, and it should be a good webinar. Conal, if you can click ahead again. The next thing I want to make you aware of, for all our PQA procedures for quality audit license holders, you should be aware at this stage that we issued an update to the PQAs. We issued this just before Easter, and there would have been an email sent out to all of our actual existing license holders. The previous version of the toolkit, it's our first update in about 18 months plus, and there has been some changes, of course, and the big ones are around ISQM, and also with relation to fraud, and also ISA 315, and of course financial reporting moves on as well, and we'll be touching upon the periodic review in a couple of minutes. So we had to update our toolkit to reflect these changes, and if you click to the next slide, Conal, I'm going to tell you a little bit more about, first of all, my main advice to anybody is, if you are a PQA license holder, to ensure, or if your practice is, to ensure that you actually download these, and for all new audits you begin to use them. We do often get queries from people who are unsure of what version they have, or maybe their actual haven't updated their records, or who receives the toolkit updates and so on. So to make sure that everyone in audit in your actual firm is using these going forward. And if you have any queries on the actual updates, you can forward them to practice members at charteredaccountants.ie, our actual email address. Again, if you're not a PQA license holder, you want to learn more, you can actually look at the toolkit and learn a little bit more details and even buy it on our online shop. We do have an auditing webinar coming up next Thursday morning. Very well booked. Booking levels are very high at the moment. And we're going to focus there on 2 things. Firstly, the key auditing issues for the UK and for Ireland for SME clients in 2023. And of course, they'll come into certain areas like ISQM, ISA 240 and 315 that we mentioned there as well. A lot more like going concern, estimates and so on too. And we're going to actually use that as an opportunity to help you adopt the new toolkit. So we're going to show you where the key changes are there and it's related to the standards. So a very informative actual session there next Thursday morning. If you want to learn more, click at the link there. If you can click ahead again. That's me in the PQAs, the final news item here from me, the periodic review of UK and Irish GAAP. It's great to have Mike O'Halloran on from our professional accounting team in the February edition, and went into a lot of details. And we just want to remind you that FRED 82, which is the actual proposed amendments to FRS 102 coming from the periodic review that has been undertaken by the FRC in this area over the last 18 months or so, is still out for consultation. You can put in your individual. The Institute has collected up comments from members and is going to put in a response to actually to the FRC, or I think it's largely done or maybe gone in already. But you still can, if you want to put in your own individual comments, you can actually reply directly to the FRC. That first link there will give you all the details. We were delighted as well to have senior representatives of the FRC live in Dublin for both a summary of the key changes and also to discuss in a roundtable and get members' input on the 29th of March. Very well attended forum, I think about 50 or so people along with it. If you missed that, you can actually get a recording of the summary presentation where the FRC representatives outlined the key changes. And also as well, our colleague Mike O'Halloran has completed a very good article in Accountancy Ireland, in the latest edition. You click to the link there, and he goes in depth into the 2 changes that will really impact for the SME accountant. and that would be around leases and operating leases and the accounting for them, but also about revenue recognition. So if you want to get under the bonnet, get a bit more detail there, Mike's article is a great starting point. Well, I think that is me done on my news items. If you click the next slide, I'll find out. Yeah, it's you. You're going to tell about your lead article, and a very good lead article as well.
Thanks very much.
Practice Matters.
Thank you very much, Jeremy. Listen, come here, just before I launch into it, is there a link to Practice Matters in the slides, in the slides that we
is, and if you go back there, there was actually just before the news stories, I showed a picture of the cover, and they get all this edition and the past editions, so it's there. That's
a live link. Great. Listen, I suppose the reason I'm asking is I really do want to encourage people to read the article and indeed to read Practice Matters and to make sure that you get Practice Matters. We always reference it in Practice News, but it's a separate publication in its own right. There's things in it which aren't necessarily fully dealt with here in Practice News. So please do read it. I know it used to be a paper document that people used to keep it, and people used to keep ring binders of all the old Practice Matters. I don't see so much of that now that it's emailed out to people. I suppose times have changed, but you know the same sort of information is still there. So I'd encourage that. Look, this article was all about the CSRD, the Corporate Sustainability Reporting Directive, which has been passed and which now Ireland is obliged to put into law. So this applies to you if you're have anything to do with Republic of Ireland reporting. So look, it applies to a range of entities, but the ones we want to focus on here today, because they affect most people here who I know are on Practice News, are people who have large private companies as clients. Okay, now a large private company isn't that large anymore. You're talking 40 million turnover, 20 million balance sheet, and indeed what Jeremy was just talking about there, Fred 82, when that comes in, and I think as well, the leasing aspect of that will bring more companies in. So there's going to be, you know, and indeed inflation, as we all know, is running along each year. It is gradually bringing more and more companies into the large company bracket. So I think people will have this as a deadline, a live deadline for your practice. If you have any large company clients, look, it's going to impact on those clients for years commencing 1 Jan 2025. Okay, so that's coming at us reasonably quickly. There are two aspects to reporting and assurance. Okay, so the reporting aspect is going to be driven by a set of standards, the sustainability reporting standards, which there's a link to in the article. I would strongly encourage people to start just looking at them, go into the website, download them, read them initially, just to get a sense of the scale of this thing. It's quite, you know, each one of those is about 12 of them, I think, and they're each 50 or 60 pages long of very detailed requirements. So you begin to see that this is not an insignificant undertaking to develop your knowledge of this thing. Now that's the reporting aspect of it. There's also going to be an insurance and assurance aspect. So essentially, all these companies are going to have to include what is called management report in the directive, which I expect in Irish law is going to become the director's report, an IXBRL version, tagged version of this sustainability report, which is going to be quite detailed. And then that is there's going to be an assurance report required to be given on that by somebody suitably qualified. So I get, and there's going to be a grandfathering process up to 1 Jan 26 is where that takes you up to for those individuals who want to become qualified individuals for the purpose of giving sustainability assurance. Okay, it's limited assurance, but I mean, when they say limited assurance, it seems to me that there's a reasonable amount required around that. But in any event, the standards around that haven't yet been finalised. So it remains to be seen exactly what's involved in the assurance engagements. But as you can see, there are choices here for firms. So there's obligations, obviously, first of all, choices. So how are you going to approach this? Is this something where you are going to become expert, if you like, in advising your clients in how they must report? Are you going to assist your clients in reporting? And are you going to give assurance around this? Are you going to do it yourself? Are individuals within your firm going to do it? Are you going to hire in the capabilities to do that? Or are you going to advise your clients, look, this isn't something our firm is going to be involved in. You need to make your own arrangements around this. And this is going to come, you know, given that either you or your clients are going to have to develop this knowledge over a relatively short period of time, given that we're all very, very busy. It's you know, this is not something to be underestimated. The scale of this. So look, and also there's, you know, obviously you cannot do all of the work. Write the report for your client and then get the assurance. I don't think that's going to be a runner either. So how that is going to work in practice is going to be something that thought needs to be given to. So there we go. I'd recommend people, just as I say, to have a look at the article and to reflect and to make a plan and to determine how you're going to achieve what is, you know, what is going to be a requirement in a relatively short period of time. So back to yourself, Jeremy, I think.
Indeed. Thanks very much, Conal. Yes, indeed, there is no escaping sustainability reporting. Yeah, there can be a lot of people in conversations I've had with small practitioners saying it's not relevant for them, or it's going to be years and years away. As you've outlined there in that article, no, it's something that we all have to be thinking about and building up our knowledge from now. So listen, on to our next piece, and I'm delighted to be joined here today, firstly by my professional accounting colleague, Dee Moore, and also as well by two guests related to the Dublin Local Enterprise Office. Firstly, by Greg Swift, who is the Head of Economic Development, and I think, Greg, I may not have given you your full title there, and also by a business leader and also connected with the WLEO Carmel Siri and a fellow accountant. And the Dee, Carmel and Greg and other accountancy bodies and so on as well have been working together as to how they can actually help SMEs and their accountants to improve the quality of reporting and consequently make the actual, I suppose, grant process and so on and decision-making process for the LEOs right across the Republic of Ireland, but also even applicable across the UK, as well as, I say to you, the same general teams, how to improve that and make it an easier process. Without further ado, I'm going to hand over to Dee, and Dee, you can tell us a little bit more.
Sure, that's great. Thank you, Jeremy, for the slot, and good morning to everybody. This is just a brief discussion on the local enterprise offices, or LEOs as they are known. And LEOs provide direct financial supports to micro businesses, which are those with 10 or less employees in general. There can also be, for criteria, those with, for more than 10 employees. But they advise on funding options, and they offer advisory services and enterprise support as well as training. I think they're a very important part of the business landscape in Ireland. They are the future of business in Ireland, and for accountants, they are the clients of tomorrow. And therefore, I think it's critical that we give them whatever support we can at this stage. So I'm really happy to be joined by Greg Swift and Carmel Siri from the LEOs, and they're going to tell us a little bit more about the LEOs and how we as accountants can further assist the micro businesses that they're involved with to help them grow and flourish. So Greg, I might just turn to you first. If you want to just maybe tell us a little bit more about what the LEOs do and what the LEO evaluation committees, you know, want to see from a financial perspective, and what areas the accountant should focus on.
Yeah, that's great, Dee. Can you hear me there? Yeah.
Yeah,
yeah, grand. Look, that's great. Thanks for the introduction there. I suppose just to say there are 31 LEOs. They are located in the local authorities, and Enterprise Ireland sort of coordinate the LEOs. So we're very much linked with Enterprise Ireland and also the suite of grants and supports that Enterprise Ireland provide. And we're funded through the Department of Enterprise, Trade and Employment and European funding, just to mention that. Each LEO is located in, there's a LEO in every county, and then there's a LEO in every local authority. So some of the Dublin and the bigger cities like Cork would have more than one LEO, just to say that. Now, in terms of why I suppose we sort of got involved with yourselves, over the last number of years, we've seen the standard of financial reporting and the sort of financial information that we request in order to provide a grant for approval has dropped significantly, really, over the last number of years. And it is a big concern. And we find ourselves trying to do more and more work with startup businesses, with clients, to address that. And it does cause us great problems. Like, each LEO would have an evaluation committee. The evaluation committee is made up of 7 members. There's a senior executive from the local authority. There's an Enterprise Ireland member. There's a banker, someone from the banks. There's an accountant, and then there's a number of entrepreneurs. So they're the people who are looking at the applications that come in through our system. And I suppose the slide here just says the type of information from a financial point of view that they are reviewing. So there's 3 main documents we look at. There is the cash flow, and we're looking at cash flow projections. And Dee, just this, and thank you to yourself and your colleagues. You worked very closely with our LEO unit, the main unit down in Shannon that Enterprise Ireland work with, to develop a new set of templates, which we're trialing at the moment. And there are a couple of glitches in them, but we're trying to work through those. But they look like they will hopefully address a lot of the issues that we've been experiencing. But nonetheless, the main thing is there is a template. There's a cash flow projection. The second thing we look for is a set of historic audited accounts. Obviously, a small business, we're working up to 10 employees. They may not necessarily have fully audited accounts, but we do tend to get sometimes abridged accounts, and we sort of have to go looking back to the accountant for a full set, trading, profit and loss and balance sheet. That happens all the time. And the third thing we're looking for is then the most recent management accounts that sort of bring the most recent set of accounts and the current position of the business financially. So, in that regard, we're looking for probably within the last 3 months, trading accounts, profit and loss balance sheet. They're the sort of, again, there is a template now for these things, but it's really just looking at the most up-to-date information. So, Dee, I don't know if that covers what you asked there.
Absolutely, yeah. No, that certainly does. Thank you. Just then looking at kind of, I suppose, the main issues or the areas that might be improved upon. I'm not sure if it's yourself or Carmel want to just take that question, please.
Yeah, Carmel was going to cover that, yeah.
Okay, great, thank you.
Hi, great. Thanks a million. So thanks very much for having me. Now, so I am a CMA accountant, so please don't hold that against me. But I do kind of straddle both worlds. I'm working closely with Leo on the grants and also within my own business and consultancy. So I kind of see things from both sides. So I do know the clients are at best can be challenged, or at worst can be challenging, and at best are a dream. So a lot of them fall in somewhere in the middle. I suppose, as you know yourself as accountants, when you pick up a set of accounts, you know whether or not you believe them, and you know whether or not that the person that is presenting those accounts understands them and stands by them. And there's this little bit of a disconnect between what the accountant gives, what the client understands, and then what they're presenting to the Leo committees. And this is where the disconnect is. We've gathered some of the most common areas but they are quite, it is quite general then, quite broad. But basically they come into being consistent and realistic. So the idea is that the information that, sales projections are often too optimistic. And I know you have to be believing your product and you have to grow. So I do understand being optimistic is an important part of a startup business, but there has to be some backup to it, and there can't be numbers that are plugged from the sky. So things that if you're going to project to have 1 million in the second year, this is things like this is working with our this client who has this potential, and so on. Often we see totals at the end of a cash flow and then divided by 12. So there's this sea of numbers that are, you know, marketing is 100 euros a month and all the rest. There's all that sea of information, and it doesn't take into consideration how the ebbs and flow of that particular business, you know. So sometimes some companies shut down for summer, sometimes a lot of companies ramp up at the end of the year, and you need to see that in the accounts, and particularly the forecasting. And then again, just the historical information and tying in with the forecasted. The next one is we're talking about being correct and balanced. We as Greg said there, we're looking for the filed accounts. We're looking for management accounts of the previous financial year, if it's around this time of the year for December. And then we're also looking for management accounts for the first couple of months of this year. They all need to kind of tie in with each other, and it can be it's amazing how sometimes they don't. So the filed accounts would always be seen as obviously the actual Bible, if you like, and then coming on from that, all the other information needs to tie on and follow into that, and often it's not. The cash flows tend not to take into account debtors. Now, I know businesses are changing. We no longer have the 60, 90 days for most companies. Some companies we still do, but debtors still is a part of the cash flow that needs to be taken into account, and that in the cash flow. And I know from working with smaller clients, when they don't have that in the cash flow or plan for it, they can get really stuck when the payments come up every 2 months. So it's moving away from the cash flow forecast being a way of getting finance or getting a grant, as opposed to putting it into the business as a working document that they can use to strategically manage their business. And it's just bridging that gap into the business that we want to encourage. And if we're all saying the same things, then hopefully the client will pick up on this. And then there's the commercial oversight. So, you know, you've got to be able to stand back and look at it and see whether or not it's commercially viable. And this is where the mistakes and often I feel that they take the information from the accountant and then just hand it over. So it's just about really encouraging the client to own their own information, and be able to stand over it and work with you and work with us. So they're building a better future for their business, because it's not a tick boxing exercise as much as it falls into that. It is about helping. The whole Leo process is about helping this startup and growing business to grow. So it's just trying to get that universally across the board. And that really is me. So I'll hand back to Dee and Greg there for any questions or anything you might have.
Okay, that's brilliant.
Yeah, Dee, I wouldn't mind coming and just adding to some of that, if that's okay.
Certainly, that would be great. Thank you.
Yeah, look, I just think, you know, as we were saying, you know, that the standard has dropped, and I think it is a big problem facing all, you know, the small businesses, the startups, and as you said in the introduction, you know, we need these startups. We need them for, you know, jobs, for economic development, for exporting, and the future. So it's really crucial we get them off to as good a start as possible, and the Leo is here doing that as much as possible. We're just seeing finance as being a real, you know, it's becoming a glaring problem that we're seeing in our daily, you know, in our daily activities in terms of processing, you know, the applications and meeting clients, and just their attitude the attitude that's coming across for finance is probably pretty poor, really. You know, as Carmel was saying there, you know, some of the reporting we get is possibly just to get a grant, really, rather than, you know, what really is needed here is, you know, a better understanding of the owner, of you know, what financial reporting they need and trying to get systems in place that will deliver those. And also, I think one of the big things we'd like to see as well for the accountants is that there's a good relationship, that relationship between the startup, the growing business and their accountant, that it's focusing more on adding value. If we could get over that, just here's a set of accounts to get through a grant, and more added value around the issues that Karma was highlighting there, like looking at the debtors, if they're too high, or that the cash flows are right, when they're going to need money and at what point. They're the sort of things that we would like to see, that relationship being built stronger with all the accountants. So I think that's probably the key things I have to say about that.
Okay, brilliant. That's great, Greg. Thank you very much. And I agree with you. I know from talking to you, I think maybe some of the improvements on the templates should really help. I know you also run courses, and certainly we will put those out on our website, I think, for those small enterprises that would engage in courses like that, so that they would really better understand themselves what to do. I think it would be great. Just a couple of comments which I might let you know from the Q&A. So one is just that the first one is just that cost has been an issue for applicants, particularly for startups and micro entities, because they need assistance for putting together projections and that. The other one, and maybe this is just one that you can comment on, is that we regularly have clients ask us to just sign this template letter re-grant claim reviews, and they're surprised when a fee is charged that it is just a letter, as Leo has already given them a template. And the question is, as part of the grant application process, are clients advised that the accountant will be required to review the claim?
Yeah, no, that's a very good question. I think there is a big issue around cost. I've talked to a number of accountants, and there tends to be sort of like I don't know, 500 or 600 euros. These startups are really, as everyone knows, are strapped for money. They're trying to get their business started. They're trying to get sales. So finance is a huge issue for them. There isn't huge funds there. So I think accountants who are getting into this area probably should be aware of that. I think when people are starting a business, there's a bit of goodwill goes to them to try to get them off the ground, and hopefully then they grow and they become big clients. It is an issue that we have picked up with the relationship between particularly the startups and the accountants. In terms of the letters, we do ask for those letters, yes, and we do expect that there would be a cost. It probably is just to verify if the accountant has looked at the figures that we're able to stand over certain aspects of their business that they're correct. So yeah, we do look for those letters, and we do value the work of the the accountants to be able to give those sort of verifications for us. So.
Greg and Carmel, I think we're out of time, and that's great. Really appreciate you coming on. As I say, we're very happy to continue to work with you, and we will let everybody know when those new templates are available. So many thanks. There is a slide there which has all of the useful links for the Leo information. Thank you.
Thanks, Dee.
Thanks very much, Dee. Jeremy.
Jeremy, if I can.
You can indeed. I know you have thank you for that session actually to Carmel, to Greg, and to yourself. Very insightful there. Yeah, it's I think cost, as I say, the level of detail that can be asked of an accountant can be a great challenge there, as I say to you. So definitely the template will be of benefit, and whatever else can be done to help, I suppose, these startups with the costs, as I say to you, that might be something to investigate as well. I know you have some other issues that you'd like to highlight to us. So for a few minutes there, it's all yours.
Brilliant, Jeremy. Thank you. This is very brief. We have just issued a few new web pages on the technical hub of the Institute website, which are on protected disclosures or whistleblowing. And these came up really because of the Act, the 2022 Act. So you'll see there the the main issues that are looked at. It is both for Ireland and the UK, so hopefully members will find that useful. We also just wanted to alert you to a webinar which is on the 9th of May at 10 o'clock, and it's with the Institute of BDO. We have Barry Robinson, who's Head of Forensic Services, is joining us. We have a couple of other people on it, and this will really provide an overview of the legislation. There'll be some interesting client insights and their experiences. We also have somebody to do a demo of a compliance tool, which members might find useful, and we'll do that at the end of the webinar. So that's the 9th of May at 10 a.m. and the link to the register to register for the webinar is there, or it's on the website. And then I just wanted to cover very briefly the Companies Registration Office and the requirement for the directors to submit their PPSN for certain forms, which you will know about. This was due to go live on the 23rd of April, which would have been Sunday. We understand that there have been some technical issues, so it's been slightly delayed. We think it'll be about 2 weeks, but we did just want to alert the members to it. I'm sure everybody is probably aware of this, but the PPSNs are now going to have to go on Form A1, B1, B10 and B69. And what will happen is the CRO information will be matched with the data held on the Department of Social Protection. If there isn't a match on that, then there is the potential for it to be rejected. You obviously don't want that to happen, particularly later in the year, which could have serious consequences, such as loss of audit exemption if you cannot upload the file. So, I think one of the most common ones, perhaps, that there might be, apart from just a slight difference in names, which should get through, because it doesn't have to be an exact match, are those maybe who have a maiden name and a married name, and maybe use married name in work for the CRO, and maybe our maiden name on their Department of Social Protection. They go through the process, then that would be rejected. So for those, we would encourage you to just let companies know that the directors should, if they want, amend the data or add a name on the Department of Social Protection. For agents, I would say maybe consider the permissions for the processing of personal data under the GDPR, because you may, even if you hold a director's PPSN, you may not have the permissions to actually use it for the CRO. There is further information available on the CRO, and that is the link there. We also have a technical alert almost ready to go, just waiting on committee approval for it. And we will also keep you updated once we have a new date for the go live. So many thanks, Jeremy. That's me, unless there are any questions.
Thank you very much. There's a couple of more questions I'll leave you read there, as I say to you, Anna. And I know you're constantly in liaison with the registered companies and with the CRO on this, and more guidance will come out on this over the coming actual weeks and months. I know from talking to practitioners every week there is a lot of unease about this, and it's good to see that the CRO is taking extra time to actually address hopefully any glitches that they're actually having on the system. And I know we have had questions earlier about the match on names and so on. I think I've heard 80% match, which is good. It's not, it has to be 100%, but that's very good advice around maiden names and change of names and so on as well. So that liaison with CRO will continue with your team, and also getting the word out. So do watch the actual e-news and apply the technical updates, I think, and any other relevant information. So Dee, thank you again for that update. Conal, I'm going to hand back to yourself.
You can indeed now. And what I'm going to do now is I am going to ask Chris to work his magic and to play a discussion that I had with Damian from Acuvest earlier, about the current economic and investment environment. So Chris, if you're there, you might just play that piece for us. Damian, you're very welcome onto the program. Thanks, Damian from Acuvest. In independent investment analysts. So, Damian, tell us a little bit about what's exercising the minds of the people in Acuvest at that moment. What's happening in the economy? What's happening in the investment world?
Yeah, well, Chris, it's I suppose there's a lot going on, which as a lot of your members, a lot of the members will be aware. There's we had a horrendous year last year in markets, and while certainly from a market perspective there has been a little bit of respite in the first quarter of this year. The outlook really for global growth is weaker than it has been at any point really since 1990. We had IMF coming out just earlier this week, downgrading their 2023 expectations for global growth. They're expecting it to be down at 2.8% this year, and next year still being 3% and an average of 3% for the next 5 years. So really, as low as it has been for quite some time. The IMF is looking at things and saying, that they expect the developed market interest rates are going to, come back down to the very low levels because they don't think that, with the aging populations that we have and the productivity growth, which isn't really coming through at a very fast pace, that the economies can support high growth or high inflation, or high interest rates. So what we do have still in the face of that is we have inflation is still a very big concern. Like we are seeing inflation coming down in the US and in Europe, thankfully, but unfortunately the core inflation, which is what really is what's going on underneath in the economy, is continuing to increase both in the US and the EU, and both actually sitting at 5.6 and 5.7% respectively in March. So really, I suppose what we've got at the moment, we've got economic growth still quite slow, and the outlook for that being quite low. We've got labor market conditions are still very tight. Thankfully we've got China open for business again since the end of last year, which is good from a global perspective. And there are some signs that maybe the US and the UK might avoid recession. So there's some positive stuff, but really, corporate earnings is going to be the key driver of outlook at the moment. You've got the ECB and the Fed still looking to raise interest rates because of the requirement to bring inflation back under control and try and manage expectations and make sure that we, I suppose, trying to balance that tightening of interest rates and hiking of interest rates, and that tends to be a slower of economic activity. So they're trying to bring the inflation down a little bit, back down to manageable levels, but without actually absolutely killing economic activity. And obviously at the same time we have still very, very high political tensions, which is sort of bubbling away in the background there with Russia, Ukraine, US-China relations, not at very strong points at the moment, and so that's really been the backdrop that we're seeing in the markets.
Yeah, so obviously you got twin stressors there. If you consider sort of your indigenous businesses, they're dealing with higher interest rates, they're dealing with higher inflation, but equally from the investor point of view, that's going to have, these stressors are going to have impacts on investment decisions.
Yeah, absolutely, and it's making it. You can see these stresses and that higher interest rates and the higher inflation are really starting to sort of hit different segments of the economy. I suppose we're in a very different regime than we've been really since 2012, 2013, where rates have been being cut sort of since that time, and so now we've got a massive change in the interest rate curve. In fact, I have a chart, Chris, that I'd like to share, which might help illustrate, the movement and the extent of the movement that we've seen. So hopefully you can see that chart. Really, what I'm showing here is the interest rate, the yield curve on European government bonds and AAA rated European government bonds. What you can see here, this orange line here is the yield curve. So if I was to buy 5-year government bonds at the moment, they would be yielding me 2.5%. You can look at 10-year government bonds are about the same, and all the way out they're pretty much the same. If you compare where we are now on that perspective with where we were a year ago, the start of January last year, that's that green line that we're seeing here, and we were in that negative interest rate territory. So what we've seen is for governments, their fundraising, and for corporates which sit on top of that, anyone that's issuing debt now, is paying 2.5%, yield on that, whereas a year ago they were paying, they were getting negative stuff for very for the short end of the curve. So as we've seen that having an impact on lots of things in terms of, from an investor perspective. If I've got defensive assets, I would typically have them invested in cash and secure bonds. A year ago, I was facing to struggle to make positive yield at all, rather than on those investments. Now I've got an opportunity where I can suddenly start getting positive returns on those. Unfortunately, one of the things that we're seeing as a consequence of that is a big stress in the eurozone and banking sector, because what banks do essentially is that they borrow short, so they get deposits from depositors and they pay the short-term interest rate, and they lend long. I've got another curve in here which is sort of this was the interest rate, the bond yield curve 10 years ago, back at start of 2013, and you can see that at that time, this is a more normal shaped curve. So at that time, if I was putting money with a bank or with a government bond for a very short space of time, I was getting very little return. But if I gave it to them for 10 years, I was getting a significantly higher return. That's what they call an upward sloping yield curve. What banks play off that, because banks have that as their base rate essentially, and then they add a margin to that. So depositors would have been getting a small amount of return here, and borrowers would have been paying a lot more out here, which is what working off that blue curve. If we look now, where things are is that deposits potentially, banks are having to contend with having to pay higher interest rates for deposits, because otherwise people will put it with the government or the ECB, and they are because interest rates are coming up at the short term. We're seeing interest rates at the moment for ECB is 3.5%, but unfortunately, because the market believes that that's going to come back down again, the long end of that curve is lower than that. So that's what we call an inverted yield curve, and really what it's doing is that right now, I suppose we had a couple of bank collapses in the US. We had Silicon Valley Bank, Signature Bank, and another couple of regional banks that collapsed. We had obviously a lot of issues in Credit Suisse in the European market, and essentially what happened there was, what happened certainly in the US was that Silicon Valley Bank had taken lots of deposits from people and invested it in that bond yield curve that was way out here, and then the movement had the rates went up, the value of those bonds went down, and the depositors started taking their money back, so they had to win cash and lose money. So that created concern in the market, because obviously if I put my money on deposit and I'm not sure that I'm going to get it back, well, that's not a good thing, so I want to take it back, and risk needs to be rewarded, and what we see now in Europe is that bankers are not still paying high interest rates for deposits. So depositors are looking and saying, well, actually, is there a better place that I could be putting that? And number one, if there's a concern about European banks, are they going to go bust? Or number two, I'd like to get return. And so what we've got from clients' perspective is we're looking at moving people's deposits into money market funds, which are able to capitalize on that short end of the yield curve, which I showed, which is producing yields of 2.5% to 3%, and that's much better than the deposit rates, which are still sitting at zero.
Absolutely. So there's it sounds like there's a call to action there for anybody who has funds which need investing, and that you won't get a return on that in the deposit market, but that if you look at at unit funds, for example, that's possible because these are based on government.
It is, and so
yeah.
So times are uncertain. So people that have large amounts of cash, they're not still. We're not advising them to throw it straight into an investment portfolio at the moment. We'd be looking at averaging in and looking for maybe falls in markets. But in the short term, if you've got money on deposit, previously, if you put it into a money market fund, you were paying negative yields away because the interest rates were negative, and you had to pay management fees on top of that. Now the short-term interest rates are strongly positive. So even if you have to pay management fees, of 0.25% or 0.5%, if the underlying assets are yielding 2% or so, so your net return is significantly stronger than you're able to get on deposit, because I suppose there just isn't competition for deposits at the moment. In fact, there was an article in the Irish Times earlier this week making the same point about how deposit holders are not being rewarded to the same extent as arguably they should be. And you certainly see across the US and across markets in general, you are seeing a degree of exodus of deposits from banks, sometimes because of maybe concerns over banks, probably in the US, but I would say primarily because people want to start earning returns on cash that's sitting there in light of higher inflation and higher interest rates.
Absolutely. Well, it does sound like there is a degree of caution required around all of this. One area of caution that I would just remind our members of is that the whole area of investment business. A lot of people have got out of giving direct advice in recent times because, I mean, essentially they've been, that the regulation has become so much tighter around it. So therefore, I suppose what people tend to do is to make referrals, is to refer clients to investment advisors such as yourselves, but just to remind people that potentially it could be a regulated area, and just to follow the rules around that. If you're making referrals, generally speaking, make sure that you've got the lowest level of authorization in order to do it, and perhaps you put in place an engagement letter as the accountant and the client say we're referring you on to somebody else.
Yeah,
I think there's cases when it's not a regulated activity, if it's specifically in a life product wrapper, but that's probably a bit technical. In fairness, probably best. The accountant is best to treat it as though it were regulated activity and to go on that basis. Anybody wants to talk to me about that at any stage, by all means, happy to help people around that, and if needs be, to put that into a subsequent edition of practice news, just to remind people what they have to do in order to comply there.
So if I was to summarize kind of the things that I think at the moment, like it's a good idea to develop a plan. There's a lot of uncertainty out there. There's a lot more will become clear through this year, I think, when we start seeing hopefully the peak of that interest rate cycle, the rising cycle that we're in at the moment. If inflation does start to come under control, or we start to see a recession coming on the horizon, things will become potentially a bit more volatile. I would suggest that trying to have a plan of what you might do if A or B takes place is a good thing to have in place, rather than finding yourself in the midst of a bit of a panic and then trying to firefight at that point. So it certainly is, have you have a plan, we would start moving people towards whatever their ultimate investment portfolio is. Not to panic at the moment, take advantage maybe of potential falls in markets, and in the short term to be looking at, if you have a lot of cash, make sure you are earning something on it, or you're happy with where it's sitting at the moment. There certainly, we don't believe that there is a massive risk in the European banking sector, but there's not no risk. So make sure you're being paid for risk that you may or may not be taking.
I mean, I think that's very helpful advice for our members. Thank you very much for your insights there. I look forward to talking to you again soon.
Great. Thanks a million.
Great, Conal. That was a very insightful update from yourself and from Damian there. A lot of uncertainty in the markets, and it's a great background.
Yes, absolutely. There's certainly some takeaway points there for members, both around the decisions that you have to take from an economic point of view, from an investment point of view, and also from a regulatory point of view.
And we have Leontia as well with our Northern Ireland tax recording. And Leontia has had a busy couple of months as well, just like your road with the spring statement and everything else as well. Listen, roll it there. You're the new Colette from the Late Late. Roll it there, Chris.
Hello there and welcome to this April 2023 UK tax update for Practice News. Well, it's certainly been a very busy couple of months since my last update in February, with the Windsor Framework announced on the 27th of February and the Spring Budget on the 15th of March, to mention just two major milestones. So hopefully most of you know me by now, but for those of you that don't, my name is Leontia Doran and I'm the Institute's UK tax specialist. In this short recording, I'll be providing you with a brief update on what's been happening since our last update in February and what we as an institute have been working on for you, our members. So the key work streams and recent developments that I'm going to be covering in the update are covered briefly on this slide. Firstly, we're going to start off with HMRC services, including restrictions to the agent dedicated line. We're then going to move on to making tax digital and particularly the small business review. EU exit is our next topic, followed by the new tax and financial year overview of key changes. And finally, we're going to round out with some consultation work that we'd like your help with. So firstly, starting off with the HMRC agent dedicated line. Here I want to cover two specific issues: how HMRC services currently are and the experiences you're having as our members, and the recent restrictions introduced on what types of queries HMRC's agent dedicated line are dealing with. So firstly, just to mention that in February, HMRC held its first full face-to-face stakeholder conference since 2019, and that took place in London. I was in attendance at the conference, which was opened with a speech by the CEO, Jim Hara, in which he apologised for the inconvenience caused to taxpayers and agents alike by HMRC's poor service levels. Mr. Hara also referred to several specific hotspots which affected HMRC performance in 2022 and mentioned a number of continuing challenges, including limited and falling budgets for the department and the current inflationary environment, both of which they recognise continue to impact service levels. Now, what was really clear to me from Mr. Hara's speech was that HMRC is very keen to enable taxpayers and agents to move to self-serve online as much as possible, obviously because they think that that will reduce the need to contact by phone and post. And this particular move to online was further evidenced during workshop sessions at the conference, which examined HMRC's ambitions for introducing new agent and taxpayer digital services in 2023 to reduce the need for contact by phone and post. The conference workshops also looked at the issue of simplification, now that the Office of Tax Simplification has closed and HMRC and HM Treasury are essentially directly tasked now with the tax simplification agenda. At the conference, I made the point once again that legislative complexity goes hand in hand with administrative complexity, and that the government should consider implementing a confidential sandbox approach to development of tax policy that examines proposed policy changes even before budget day. Now, this is not a new recommendation of the Institute, and it's one we've previously made in our response to the HM Treasury consultation in 2021, where they were conducting their 5-year review of the Office of Tax Simplification. Overall, therefore, we'd like to hear your feedback on current HMRC service levels, which we continue to discuss with HMRC as their programme of forum meetings continues. Now, in order to do that, I really would encourage you to get in touch and provide us with up-to-date feedback on your experiences. Okay, moving on to the agent dedicated line. So more recently, and quite disappointingly, it was announced that in the period 17th of April to the 2nd of June, a 6-week window, HMRC is restricting access to the use of the agent dedicated line. In this particular time window, the agent dedicated line will only deal with queries on self-assessment late filing penalties and PAYE coding notices. If a query can't be resolved via the ADL, HMRC's advice is for agents to use the online service, if relevant, or main helplines instead, for example, the employer helpline. Now, the decision to restrict the ADL once again, because it was restricted, remember, back in January, is a concerning one and raises the question of how the ADL will be run in future. So it is something we will be discussing with HMRC. HMRC are keen to say that the restriction is temporary, but because it is the second such restriction in 2023 and comes against this background discussed at the conference of resource and budget constraints in the department as it seeks to move to develop these additional services. So the decision to restrict, unfortunately, had already been made when HMRC shared details of the restriction with the professional bodies. We are discussing this with HMRC, as I mentioned, and we would really welcome your feedback on the impact of this restriction, particularly in the context of progress chasing calls in areas such as repayments. So moving on now to Making Tax Digital and specifically the Small Business Review. So in my last update, I mentioned that the government had announced an informal review into the needs of smaller businesses and particularly those under the £30,000 income threshold. That review is considering if and how MTD for income tax can be shaped to meet the needs of smaller businesses and the best way for them to fulfil their income tax obligations. It's also aiming to inform the approach for any potential further rollout of Making Tax Digital for income tax after April 2027, when businesses with turnover between 30,000 and 50,000 will be mandated to join. Remember, businesses with turnover of 50,000 or more will be mandated to join from April 2026. So once this particular Small Business Review is complete, the government is aiming to lay out plans for any potential further mandation of Making Tax Digital for income tax. Recently, Chartered Accountants Ireland and several members from a range of practice sizes met with HMRC as part of the Small Business Review. During the meeting, we stressed that the MTD for income tax threshold needs to be more realistic and should be set at the VAT registration threshold, which is currently 85,000. We also expressed concern that there are no plans currently for agents to be able to bulk sign up clients to MTD for income tax. We're also concerned that the trial will only be public from April 2025, which will not allow one full cycle to be completed before mandation from April 2026 for the turnover less than 50,000 population. And we've cited the importance of ensuring that free bridging software is available. As a final point, we clearly referred to the need to simplify the UK income tax system. Overall, on the issue of Making Tax Digital, just to remind you that forum meetings are held every quarter and we'll continue to represent your views at these meetings. Turning now to EU exit. So it's certainly been a busy few months with EU exit. So as you know, and I covered in the February update, the replacement legislation for the VAT second-hand margin scheme commences next month from the 1st of May. This is going to be called the Second-Hand Motor Vehicle Payment Scheme. Where specific conditions are met, this will allow businesses to claim a VAT-related payment if they buy a second-hand car in GB, England, Scotland and Wales, and move it to Northern Ireland for resale. Representatives from the NI Tax Committee and VAT specialist members of the Institute's member firms recently met with HMRC to discuss the guidance and scheme rules. Members are asked to get in touch if they have any specific queries on the scheme, and we can feed those back to HMRC. In addition, in the last few months, the Institute also received a response from HMRC on the 3 remaining issues raised in our letter sent in January, which I referred to in the February update. You can read that response on our website. But overall, as a result of the response and the Windsor framework, which I'll come to in a second, we're very hopeful that the Trader Support Service will either be made available as a permanent resource or alternative provision for customs declarations will be made permanently available in future, and that is a key recommendation of the Institute. And finally, as we all know by now, the Windsor framework was announced in February and was ratified by both the UK government and the EU last month. We have met on several occasions with UK government officials since then to discuss key aspects of the Windsor framework, and we will continue to do so. Essentially, the key advice is that businesses should continue to move their goods into and out of Northern Ireland in the same way as they currently do, using existing published guidance to support them to move their goods. The relevant guidance will be updated in due course, and businesses will be given time to prepare for new requirements, which are expected to begin to take effect for goods movements into Northern Ireland from the 1st of September 2023. Members are also being kept updated in Chartered Accountants Tax News, which in March featured an analysis of the changes as a result of the Windsor framework. And of course, as usual, if you have any feedback on EU exit issues, please do get in touch. Moving on now to an overview of the new tax and financial year that started earlier this month. So firstly, it would be remiss of me not to just briefly mention the spring budget. On budget day last month, we did issue a special newsletter to members highlighting the key tax announcements. I'm going to briefly cover key tax changes as a result of the new tax and financial year, but just to also mention that the spring finance bill is making its way through Parliament. So this is just a flavour of some of the key tax changes. From the 1st of April 2023, we have significant changes to the UK corporation tax regime. The main rate of corporation tax, remember, is now 25% with companies with taxable profits of more than 250,000. The rate does remain at 19% if taxable profits are 50,000 or less, with companies having profits between 50,000 and 250,000 paying corporation tax at the main rate but reduced by marginal relief, which overall provides a gradual increase in the effective corporation tax rate the closer the taxable profits are to 250,000. And remember, these limits of 50,000 and 250,000 will need to be adjusted for any associated companies. So the old concept of associated companies, which was relevant prior to 2015, comes back into operation. Remember also that we have various changes to rates and allowances for personal tax and capital gains tax. So remember, the dividend allowance is falling to £1,000, with the CGT annual exemption falling to £6,000. Many of these are taking effect as a result of the 2022 autumn statement, and there were also a number in the spring budget. Just to also flag that the super deduction and 50% special rate allowances for companies ended on the 31st of March 2023, but the Chancellor did announce in the spring budget that a new regime of full expensing for companies will come into operation, and that did take effect from the 1st of April 2023, with the potential for that to last longer than the initial 3-year period if the UK's economy is on stable ground. And that was actually a recommendation of the Institute that full expensing should be considered if the economy was strong enough. Changes also took effect from the 1st of April to the R&D tax relief regimes. So not only do we have additional forms that must be completed, the additional information form and the claim notification form, remember the rates have changed for most companies. So for qualifying expenditure on or after the 1st of April 2023, the SME additional deduction has fallen from 130% to 86%, with the payable tax credit having decreased from 14.5% to 10%. However, the taxable R&D expenditure credit for claims under the large regime actually has increased from 13% to 20%. We also had a change announced in the budget as well, in that loss-making R&D intensive companies, with a specific definition of what that means, will be able to claim a payable tax credit of 14.5% for their qualifying R&D expenditure. And that will take effect once the spring finance bill has received royal assent. Excuse me. In addition, the temporary VAT zero rate for energy saving materials that was introduced in Great Britain in April 2022 is being extended to Northern Ireland from the 1st of May 2023. So that's because of the Windsor framework, and it essentially aligns the VAT treatment of the supply of installations of energy saving materials in Northern Ireland with Great Britain. Excuse me. I'm turning now to consultation work. So firstly, the Institute responded to the R&D consultation last month, which is considering a possible single simplified scheme for R&D tax relief, which would effectively merge the SME and large company schemes into one. The main thrust of our submission was that more time is needed to consider the potential merger of the two schemes into one. We also made several key recommendations, which you can read about in the submission in the tax representation section of our website. Next up is some consultation work we'd be keen to hear your feedback on. Firstly, we're submitting a brief response to the House of Lords Subcommittee's Protocol Committee their call for evidence on the Windsor framework, which closes on the 3rd of May. So please do get in touch if you have any feedback. The Institute is also considering a response to the spring budget announcement that from April 2024, agricultural property relief and woodlands relief for IHT inheritance tax purposes will no longer be available on land situated in an EEA state, the Channel Islands or the Isle of Man. So that was completely unexpected. And finally, we'll be responding to the consultation on simplifying and modernising HMRC's income tax services. Now, this discussion document is open for responses until the 7th of June, and essentially it's looking at how HMRC can simplify and modernise income tax. It also sets out HMRC's intention to move to a digital by default approach for some of its outputs, and seeks views on improving pay-as-you-earn processes, whilst also launching a review of the income tax self-assessment registration criteria. We'd love to hear your views on each of these, and I'm going to provide you with some contact details that will enable you to get in touch. And finally, just a reminder that this recording just gives an overview only of what's been happening and key work streams. Remember, you can keep up to date with all the latest UK, Irish and international developments via Chartered Accountants Ireland's tax newsletter, which we issue every Monday. There is a link to subscribe to that on this slide. And of course, we'd love to hear from you. So there's some contact details there to enable you to get in touch with us. So the final thing I want to say is thank you for listening, and please do let us know if you have any feedback or comments. Thank you.
I'm sure you'll all join me in thanking Leontia for that very comprehensive update as ever in the area of UK tax.
So there we go. I think we're pretty much at the end there, Jeremy. I'm going to share my screen now. Just to, because I know that you put together a slide there for us, just an upcoming webinars. So we'll finish up with that.
We'll finish up with that indeed. We have a schedule, our spring, early summer schedule of webinars continues, and the next couple of weeks we have some of the key ones, I suppose, for anybody in practice. First of all, the auditing with the new 23 PQAs. I mentioned it earlier. If you are a PQA license holder in the audit area, it's definitely the one for you for your smaller clients. That's next Thursday morning, proven very, very popular so far. So definitely check it out if you're in the audit area. And also then we actually have the actual financial reporting update for SME clients and SME practices. That's on the morning of Tuesday, the 9th of May. And later in the actual month then we have our accounting and auditing for regulated clients in the Republic of Ireland. Of course, auditing and financial reporting, they're all Ireland, UK and Ireland webinars. But the regulated entities is for the Republic of Ireland, and I'm going to be joined as well by the Law Society representative Rory O'Neill. So this accounts regulations will be a big one there. Our next free practice news is on Friday, the 9th of June. So a few weeks away, less than the 2 months this time now, because Easter and so on delayed this webinar. So that is that. And if you want to learn more about our other upcoming webinars, we have annual conferences, different things, just click those links there. So Conal, we have a lot of thank yous, I think, today. I know we have some questions there as well coming in for people, and I think I covered that off there with relation to the CRO, in that we're still liaising with the CRO and we're hoping to get guidance and answers to these. I don't think we have ready-made answers there so far for how things that will play out, and particularly with hopefully these extra couple of weeks now that CRO are going to work through any technical glitches. I see a lot of practitioners getting the word out on social media and emails and so on to their clients to try to make them aware of this as well before it gets to the very busy period in the autumn. So keep an eye on your e-news on a Friday for updates from Dee and our team.
Absolutely. But one thing there which Dee did stress, which was actually raised in a question, was, well, can this potentially result in loss of audit exemption? And it can. So I think this year the advice might be to make a particular effort to leave a couple of weeks grace yourself rather than sending any returns in at the last moment. I know that's easier said than done. I appreciate that. Look, there are other specific questions being asked around that. Dee isn't on the show anymore at the moment, but we are looking at it. Obviously, there's a couple of weeks grace now been given because the CRO have not launched this particular aspect of the system. So that is a bit of respite, but it is on the way, and we are continuing to liaise with them to make sure that it is as seamless as possible. But the exact mechanics of it, I don't think yourself, myself, Jeremy, have been liaising ourselves with
no, we wouldn't be close enough to it on that, and I have my doubts maybe, and that's the actual some of the actual guidance there, written guidance isn't might be available. But one thing I know, Dee, and I often put accountants in touch with Dee, is that particular concerns and so on. She is talking to our members on a regular basis, and putting together questions and so on, and that forms our interactions with the actual CRO.
Very good. Okay, that's perfect. Look, it just remains to thank everyone for staying on. I can see there's still a couple of hundred people with us still, so thank you very much for staying with us. Thanks for all the questions and comments, really appreciate it. And all of our contributors, of whom I think we must have had a record number this time. So it was,
I think about a dozen in total, including ourselves, Conal. That is a record with guests and internal. So yeah, thanks to everyone. It made it's fair to say a very wide and varied show today. Something for everyone there. So hopefully you guys found it useful. I know we're going to be sending out the survey, and we'll send out an updated slide pack, because there was a couple of slides that came in late there, and so we'll include those as well on the LEO reporting and different things. So they'll be coming out to you early next week, and a link to the recording as well, and all those recordings of past webinars. They're actually on our Institute Chartered Accountants Ireland YouTube channel. So if you just type in Chartered Accountants into YouTube, you get all the videos of our webinars, but also past ones as well. And we have a web page for them too if you go onto our website with just the practice news ones. A lot of good free material up there from district societies and ourselves. So if you're looking to catch up on some CPD, that's a good chance.
Oh, and thanks very much to Chris for sorting out those technical issues as they arose. I'm sure you had a few moments there, Chris. And thanks very much to our sponsors, Acuvest. We're always very grateful. So there we go. I think we better sign off now. And
indeed. Well, listen, guys, we hopefully talk and to you soon. Hopefully you'll be able to join us in some of our upcoming webinars, and we'll see you hopefully for the next issue of Practice News as well in June.